Okay, so as mentioned in a previous video, there's three accounting concepts that I believe all business owners should be aware of and understand, at least to some extent. So this video is specifically about the first of those, which is the accounting equation. But as a quick summary, let's run through the three concepts. So the first one is the accounting equation. As I've just said, assets minus liabilities equals equity. The second one is double entry accounting, which is for every debit there must be a credit. That's obviously covered in a different video. And finally, the accrual accounting convention, which is dictates that costs and related revenues anyway should be recognised in the same period. So again, we'll go through that in a different video. So let's look at the accounting equation. So officially, this equation is stated as assets equals liabilities plus equity. However, a more sort of practical restatement of it is equity equals assets minus liabilities, or assets minus liabilities equals equity. Now, in this context, equity really loosely anyway translates as profit, because although there are other elements that make up the equity of a business, the vast majority of it is going to be the profit you've made since the business started. So, quite importantly, actually, the accounting equation is the basis of the double entry accounting system, which you'll see if you've already watched the video on the double entry accounting system. That will make sense. If not, it will make sense when you do watch it. So let's dig a bit deeper into the accounting equation, which is the first one. So the reason it works and the reason it feeds into the double entry accounting system is because all transactions in your business are classed as categorized as one of 5 types of transactions. And the easy way to remember the types of transactions is because it spells out the word Alice. So you've got asset, liability, income, capital, and expense. So they're the 5. Every business that goes in or out, every transaction that goes in or out of your business must be one of those 5 transaction types. So the reason it feeds into the double entry accounting system is because every transaction increases one of these and decreases another. So there's a positive and a negative entry, hence the word double entry. There's a debit and a credit. So that's why it all fits together and it all works as well as it does. So in terms of the accounting equation, these transaction types are restated as one of those elements of the accounting equation. So assets and obviously assets and liabilities are what they are, and then the other 3 elements are all part of the equity calculation. So income minus expense is the profit you've made, and capital is the money you've injected into the business in the first place. So if you put all 3 of those together, this is why I say that equity loosely translates as profit, because income minus expense is your profit, and then the capital element is not profit, but it's part of the equity of the business. So assets minus liabilities equals equity. That's how this pulls together. So if we look at that in terms of how it manifests itself in your business, you can see it in your balance sheet. So if you look at the balance sheet of your business, you can see that at the top of the balance sheet, and this is a standard layout everywhere, you've got your assets at the top, then the liabilities, then the equity. You can see that in the headings in this balance sheet. But just in case you can't see it, I've made it easy for you. So there's your assets, fixed assets plus current assets. So that's the total assets. And then your liabilities, you've got current liabilities and long-term liabilities. So assets minus liabilities equals your net assets, which is 52,387. And then your equity at the bottom there is 52,387. So as the equation says, assets minus liabilities equals equity. So if we go back a step and look at that equity section of the balance sheet, you can see there share capital, £100. Share capital is always, unless you're trading on a stock exchange, share capital is always a nominal amount. It could be £1, it could be £100, it could be £1,000. It's generally not usually more than that, but it depends how many shares you want to dish out to your friends and family. But it's a nominal amount. It doesn't change. It's the money, it's the nominal value of the shares of the business. And then anything the business has made is represented either as reserves or some different name for those reserves. So in this case, we've got retained earnings, which is the profit made in previous years, and we've got the current year profit, which is obviously the profit made this year. Sometimes that's referred to as, the retained earnings might be referred to as reserves. It doesn't really matter, it's all the same thing. It's still profit that's been made in the previous year that is being held in the business for some reason. And then dividends, which is a distribution of profit, would be a minus. It would reduce the amount of retained earnings in the business. And in this case, there isn't any, but if there were, that's where it would appear. And this is a good example of how this all works, because if you were to take a dividend out, you would reduce your bank balance, which is here. So let's say you took a £10,000 dividend, your bank balance here would reduce to 32,887, which would then reduce this by £10,000. But then you'd also have a dividend which would go in here as a negative, and that would reduce this by £10,000. So that's double entry in a nutshell. And that's why the accounting equation works. If you remember the Alice mnemonic we looked at earlier, anything where let's say you've bought a new asset. So if you, let's say you buy, I don't know, a new forklift, and that goes in here, and it's worth £20,000, right? So you've paid for it. So what you've done is you've reduced your bank balance by 20,000, and you've increased your plant and machinery by 20,000. So that's how that works out, because that's gone up 20 grand, that's gone down 20 grand. The net impact then on your net assets is zero, because you've increased one and reduced the other. As a similar example, if you were to buy a forklift on finance, so this, and again, it's 20 grand. So the plant and machinery goes up by £20,000. Your bank balance doesn't get touched because you put it on finance, but you then have a new liability here, a current liability. Well, it depends how long it's over. It could be down here, so it could be another loan. So you've got a £20,000 liability and a £20,000 increase in this asset here. So you've increased assets by 20 grand, and you've also increased liabilities by 20 grand. Assets minus liabilities, so the net effect on this again would be zero, and the net effect down here would be zero. So it all balances out, and the accounting equation balances, the balance sheet balances, and everybody's happy. So that's the accounting equation. Obviously this is just a fairly brief summary of it, but that's how it all works.